Hey all, welcome back to ShareTreck. This is part 2 of the Tesla analysis. And this part is going to get into the summaries, the conclusions of the first part. If you haven't seen the first part yet, take a look. But without further ado, let's get started. Hey there, friendos. So, Tesla earnings. It missed on almost everything. It missed on earnings. It had great margins. It beat on margins. It recognized FSD revenue, and we got a lot more clarity as to when we could expect some gigafactories. Though there is a lot to be very bearish about in this, especially in terms of cash, and especially in terms of how much they're spending, and the fact that their spend is going to actually go a little bit higher. In fact, what I'm going to do really quickly here is share a little bit of my notes, pros and cons. First of all, pros, double-digit margins, 16% margins, even after tax credits, more affordable vehicles coming, new production lines. Right now, they're working with like a hybrid production line where they're doing a little bit of the old, but they're slowly incorporating more of that AI, more of that NVIDIA chips. And we're getting clarity as to when we might see those gigafactories, primarily the Giga India eventually and Giga Mexico, and Robotaxis are coming. From the earnings, Elon Musk and a lot of the other executives say Robotaxis, ride-hailing service, very soon, probably as soon as 2025. That could be big competition and increase their Tesla's revenue. Margin without credits actually beat the expected 16.5, actual 17.5. However, cons, cash. Tesla went negative free cash flow, meaning they're spending more in this quarter than they're taking in, and they missed on everything. They missed on EPS, they missed on revenue, they didn't guide, and no news on Giga India, no news on Giga Mexico. Their sales are also significantly lower than before. But what else is going on? What else is somewhat nice with Tesla? If we were to, the problem, EPS, and problem, revenue. But a few little notes over here before I jump into what I am truly excited about, and I hope you're all going to be truly excited about, is energy storage. Although it's a very small piece, is growing faster than a car revenue business. And that could be big in the future. Maybe as the world tries to transition into more of a renewable energy environment, that sector of Tesla could be really, really positive. Moreover, I found out while listening to, I think it was CNBC or Bloomberg, that 80% of the US car market buys cars around the 30 to 40,000 price range. And EV sales, although they are slowing, that range and Tesla being open to more affordable models could open up their market a lot more. Tesla also did not disclose what solar revenue is. They just grouped in with energy storage. Tesla CapEx, very, very high. So Tesla, before earnings, trading at a 144 a share. After earnings, or around now, trading between 175 and 180. That represents about a 22% growth since those earnings, primarily because of those new models announced. But I think there was a little bit more under the hood, which is which is nice and could be something to really be bullish about soon. Their revenue came in at 21,301, pretty much 21 million, which is less than the lofty expectations from Wall Street. Wall Street, by the way, wow, really dropped the ball on these expectations. I don't know what they were expecting, but they really, really did not come even close. Or maybe it's Tesla's fault. We'll see. Somehow, Tesla reported poor earnings, but told investors and told Wall Street what they really wanted to hear, which is new models coming and margin. I talk a lot about margin. I think two of the most important things for growth companies, I'm speaking specifically for growth companies, is cash and margin. I am the concern that Wall Street had was they thought that margins were going to drop below 16% and even below 15% from what I read. Tesla margins came in at 16.4%, and that's the after credits margin. Wall Street loves hearing two things, especially during a high rate cycle, and that is, does the company have enough cash? And does the company have enough cash? And does it not need to borrow? Tesla confirmed that the other part is margins. Tesla confirmed that not only are margins remaining strong, but they don't need to borrow right now. That cash burn, however, something to making me really concerned though. During high rates, cyclical industries are often really reliant on things like financing cars, financing solar, and with rates high, financial businesses really suffer. People finance fewer cars, people buy less real estate because it's just less affordable. Showing the ability to show favorable profit margins during a high interest rate cycle, even with discounting, showing the strength that Tesla is not taking this hit in the margins makes me a little bit bullish. Even more impressive, the number margins X credits 16.4, but with credits 17.4. And if these credits were to continue, that'll make Tesla margins even better. The reason why Tesla is doing so well and is able to keep these margins up despite discounting is despite things like discounting cars, the disruptions in Berlin, the Red Sea issues, all of the other issues that come with high rates. It has to do with, in my opinion, credits and the competition not taking advantage of credits. The government offers credits for energy efficient vehicles, and for some reason, the competitors, they just have not been able to do what Tesla's able to do with electrical vehicles. Competitors are making much more gas cars, which don't qualify. And if the world is moving away from gas and going to electrical, that could show that Tesla's going to do really well. As they're able to lower input costs, increase efficiency, this could be quite a bullish aspect of Tesla in the future. A big part that really impressed investors is the acceleration of more affordable vehicles. Tesla is answering what Wall Street and consumers really, really value, and that is cheap cars. Tesla will do this by increasing their production from about that 2.3 million to 3 million, which is a 30% increase jump in production. We might not get news about gigafactories like Mexico and India for now, but we are going to get increase in production, and that might be much more important than opening up a new factory, which would cost $10 billion, which Tesla doesn't have right now at the moment. The money instead is going to capital expenditures, and Tesla is using that money in other aspects, primarily AI, to increase those costs of goods sold even further, make it much more affordable. But they're not jumping right in. No. They're doing a hybrid system. They're using what they have now and slowly integrating it in. That's really smart. From this earnings, I deduce that instead of building the gigas, they're going to focus more so on robotaxis. Robotaxis are expected to be released next year, 2025, through the ride hailing app. And just 3 days ago, Tesla, you're going to probably need to look this up, revealed a robotaxi teaser, which is kind of cool. It shows a lot of the stuff that a lot of consumers might like. A lot of things of customization. You can customize what type of music we want to listen to. Maybe you don't like the same music as Sandeep. Maybe you like something else. What type of desired temperature it is. A lot of folks really like that customization. Maybe a lot of young folks might like it. Tesla is improving their economies of scale. They're lowering their cost of goods sold. They're bringing new and old vehicles at the same time. And I think Tesla investors are really, really excited when they hear that there are multiple new vehicles. Tesla's focusing on getting different types of vehicles for different groups, and they're targeting everybody, a wide variety at different price points. And that's what audio manufacturers do. If you were to think of, I don't know, Ford or Toyota, they don't just have one type of vehicle, they get everything. However, this company is far, far from sunshine's rainbow and butterflies. Tesla missed on nearly everything. And they the little guidance they gave is they're expecting revenue growth and production growth to be noticeably lower. This means the ramp is going to increase in deliveries, but that ramp is not going to come anytime soon. There's going to be a lot more turmoil and turbulence in the short term before we see a ramp in and before we see that prosperity long term. Moreover, we don't exactly know when we're going to get these affordable vehicles and this ride hailing. We just know it's going to be in 2025, which is very vague. And the biggest negative to me is $2.5 billion in negative cash flow. And that alarms me to no end. As a Tesla investor, I'm concerned. Tesla, although they do have cash on hand, and enough cash from operations, their debt and that negative cash flow is something, if this were to become a trend, I would not be happy as a Tesla investor. Tesla might need to do a share offering if they were to carry on with this level of cash burn. If I were to just jump quickly in the numbers, I'm not going to get too much into detail. Tesla has 26 billion in cash on their balance sheet. If you were to add in receivables and inventories, which are about 22 billion, that's $48 billion in cash. Though they are the rate that they're using and they're burning, that's not that much. I'm just going to do I just did a quick sort of acid test or liquidity test for those who know what that means. Basically see how much Tesla takes in, how much they're going out. And we are down to a little less than 3 billion, about 2.9 billion in cash. With that negative 2.5 billion in cash flow, that's cutting it close. And although and the fact that they're announcing increases in production, increases in AI, increases in money spend, money, all going out this way. Where's the money coming in? I am concerned about cash. They're going to be dipping into those receivables, into those reserves very, very soon. And that's not good for a growth company. Another negative, and I didn't like this at all, the fact that they're able to recognize so much, 2.5 billion of their FSD revenue for just releasing a small part, which is Auto Park, which bumped up their margins. I don't like that. That's a lot of recognition for just a small piece. Where are we gonna jump on this? First of all, before I jump into the little conclusions, I am going to show everyone something which is a new way of doing a discounted cash flow, which I try to simplify this as much as possible. If you like this, do share. And do let me know your thoughts. What I've done here is I took a look at Tesla's average selling vehicle price, which is about 45,000, and their future, and I used a bunch of estimates over here. The number of vehicles they're going to have produce 3 million. We got that from the earnings. Their margin. Oh, so I just took a look at how much they're spending and what their cost is and got their margin of 17.4. That's after credits, by the way. Their total estimated revenue about 135 billion. Of that, they're getting close to 120 from their cars and the remainder from their energy. By the way, cars, I grouped together all the things like new cars, used cars, leases, rentals, all that in cars. I just bumped it all together. So um their energy revenue is actually going up is about 10% according to estimates, but I took the actual number. Now, what I went ahead and done here is I did a little bit, quite a bit of projecting, quite a bit of analysis, quite a bit of forward projection, which is I recognize a little bit of potential Robotaxi revenue. What I went ahead is I took 10% of what Uber's revenue is, which is 37 million, pardon me, 37 billion. So 37 billion, 10% of Uber's revenue. If Robotaxi were to disrupt and get 10%, that's going to add about 27% more revenue to Tesla. I went ahead and recognized another 2.5 billion in FSD. Even though I don't feel Tesla earned it, I went ahead and recognized a little bit more because they are most likely going to do that. Given their total revenue, adding in robo-taxis, adding in FSD, or what they recognize of 1.41.2 billion. Then I went and took a look at some of their costs, and a bunch of their costs, we get about 120 billion. If we were to do a little bit of their regular profit, that'll give them a profit about 21 billion. Estimated tax rate of 20%, giving their estimated net income after taxes about, what is that? 117, oh, pardon me, 17 billion or so. Using the following assumptions: another 2.5 billion in FSD revenue, 10% of Uber's revenue in robotaxis, and if they were to reach the 3 million mark, which they said they would, with an average price about 45. I recognize nothing for their Tesla insurance because they really didn't mention when we're going to get that. And I included whatever their Cybertruck revenue is going to be into their cars. Nothing for their robots, and nothing for their revenue. I went ahead and did a little bit of fun algebra, which, yeah, we can still algebra in finance. I'm a little. I took a look at the shares outstanding, and Wall Street expects their EPS to be 5.6, but using using their shares outstanding, I just did what was over here, which is the estimated revenue, their earnings over their shares, and I got an EPS of 4.9 if we were to add in 10% of Uber's revenue for robotaxis. The expected earnings growth for Wall Street estimates is 20%. The Tesla usually trades at between, Wall Street expects they're trading between 48 and 50 PE. I went and used 50, but if we were to use 48, that'll change the numbers. But I'm just going to use 50. If we were to do that and do a little bit of reverse algebra, which is the earnings per share times the estimated PE, a little bit of reverse algebra, we'll get an estimated 2026 price target of 200, pardon me, $246 a share, which if we were to take a look at that over 2 years, about a 22% growth, but current growth, 44% over 2 years, 22% over 1 year. If we were to just change this number, like today's 180, we could change that again and see, hey, 18% revenue growth. So this is a really, really, I hope some of you appreciate this. This took quite a bit of time, but just working backwards of seeing what their estimated revenue would be like and seeing what the outstanding shares would be and what percentage of that will go to each shareholder, and factoring in what their historic normal PE is, we can forward project and see what type of growth we could get if these assumptions were to get in. Now, some of you might think that if we were to get 180, someone might think that 18% year over year growth is not enough. Some people might think, hey, that's quite a bit. Tesla is a high risk company, but I just think that that could be something, especially in a world where we might see a kind of a topping out project in some of these companies, especially things like Nvidia, which, wow, what a company! But it might have seen a little bit of a recent top. So going back to this Tesla growth evaluations, we would take 180 and take Wall Street's estimate of forward EPS of 5.6. If we were to use mine of 4.9, we will get a forward EPS of 3.6, 20% revenue growth, and we end up getting a PEG ratio, price to earnings growth, about 1.84. But I went ahead and just changed it a little bit. I took a much more conservative estimate, and still their PEG ratio is higher than the S&P 500, which is about 1.7, 1.8, but is not too bad compared to some of these other companies. I mean, still companies like Microsoft just look amazing. Companies like Oracle still look very good. But compared to other companies like maybe Nvidia, Tesla could be something. So I hope a lot of you appreciate that, a little bit of a forward projection thing. I had a lot of fun making that, actually. If we're gonna just jump into conclusions of this very, very lengthy Tesla video, by the way, thank you if you stayed tuned until now. 2024 might not be a good year for Tesla. Expect lower growth, but the market is forward looking. Tesla might have seen a little bit of a bottoming out process, and a lot of negative catalysts are slowly disappearing. There have been some lawsuits that have been settled that have been are now in the past. The issue with Elon Musk's share plan, which Elon Musk, that share plan, by the way, it's mainly it's entirely options. His goal is to own much more of the company, and his options, which he got as a bonus, they are worth about that what was it, $50 billion. If the Tesla price were to appreciate, that package would be worth much more. If it were to depreciate, it would be worth a lot more. But Elon Musk needs cash to get those shares. So, hey, he could always sell, excuse me, he could always sell some of those options to raise some of that cash. So keep in mind that those options, I mean, pardon me, that Tesla plan, that's for purchasing shares. It's worth that much right now, but the valuation that could change. So share plan issue done. We have a lot more clarity right now. We know what we would need to probably expect before we see growth, which is around that 3 million vehicle mark according to their earnings. And we are getting new vehicles coming in. which Wall Street really likes. There's a lot of negative though. That cash issue and the fact that Tesla recognizes FSD revenue so freely is concerning, cash especially. Another negative is I want to not be political and stay bipartisan, but Tesla CEO Elon Musk, from what I read in the news, is sort of aligning himself with Donald Trump. And I'm not picking any sides here. I'm just saying that some folks who generally tend to buy Teslas and buy EVs, from what I read, are not too big fans of Mr. Trump. And that could disrupt a little bit of the voter base. So CEO going towards Trump, that might be a negative. It might sour some consumers, but hey, if Trump gets into power, maybe this means more little credits for Tesla. So it could swing both ways. Tesla's also buying a lot of NVIDIA chips. So in my opinion, not financial advice, in my opinion, Tesla might be reaching a little bit of a bottoming out process where some of the negative news is starting to fly away. And over the long term, people remember much more of the positive news than the negative news. Although that cash situation incredibly alarming, at least to me, this might be a buying opportunities if folks are extremely bullish on robotaxis and are confident that Tesla could reach 3 million vehicles. Now, I would personally, I am not considering putting a lot of money into this company. That cash issue is still a little bit, I'm still remembering him. It's haunting me. So I would consider taking out a little bit of Tesla, but I would not, at least until they fix their cash issues and give us more clarity on that FSD and not having to keep on relying on it. I would not make Tesla a large position, but I would take out a little bit, maybe do a little bit of a swing trade on Tesla. But I want to thank you all for listening to this. A lot of work went into this. If you like that little reverse algebra sort of discounted cash flow forward projection thing, let me know. If you like the old version, let me also know. But thank you all very much for paying attention to this, and I appreciate all of you. May you all be wonderful investors. Stay safe, stay healthy, and we'll be back again next week with a new company and some really good things to come. A lot of good things to come, which are up here, and I hope to talk about soon. Thank you very much. Have yourself a wonderful time, and